When discussing fundamental analysis, there are some core principles we need to be aware of. Supply and demand is at the heart of fundamental moves in all markets, including FX. Buyers, which are more aggressive than sellers, mean prices go up. On the other hand, sellers, which are more aggressive than buyers, mean that prices go down. The other most common driver of fundamentals is something called sentiment. The importance of this aspect of supply and demand should not be underestimated. At its most extreme, virtually nothing will stop a market until its participants have been satisfied. The markets are simply too large for any one entity, authority, or even group of authorities to move prices in a direction that the markets don't appear to want. $5 billion of transactions would represent a serious attempt at intervention by a major central bank, but would only represent less than 1% of the daily FX volume in London alone. Exchange rates between currencies can have a significant effect on the pricing of their related derivatives. Two theories explain this. Purchasing power parity claims that exchange rates move to keep international purchasing power in balance. So if US inflation is 6% and UK inflation is 4%, the dollar should move 2% to maintain PPP. Portfolio balance, on the other hand, suggests that exchange rates move to balance total returns. In reality, it's probably a combination of both. Central banks have two tools to manipulate exchange rates: monetary policy, usually seen in interest rate movements, and intervention. Exchange rates are generally moved by forces outside of the control of central banks. The most immediate effect of a weak currency is higher domestic inflation, although a weak currency is attractive to inward investment. Monetary authorities try and control the size and growth of money in several ways. First, setting reserve asset ratio, which affects multiples that banks can lend against. Next, you have open market operations, buying or selling government debts, often called repos. In interest rates, of course, changing the discount rate or imposing fixed rates. Credit control, limits on bank lending or consumer borrowing. And then finally, moral suasion, which is basically to persuade the banks to tighten their lending. Central banks influence monetary conditions by setting interest rates, which in turn influences the rates at which banks deal with each other and their customers. In America, the Fed uses the Fed funds rate window, while the ECB and the BOE use repos. We'll be looking at central banks in much more detail as we go into the main training programme, and you should be including these in your own research in the meantime. To get a full handle of financial trading, we need to take a few minutes out to look at intermarket analysis and how all the various asset classes relate to each other. Share prices, for example, are highly cyclical, as investors shift out of shares and into fixed income securities when they expect a recession, and then back into shares when there is an expectation of recovery. The direction of broad share indices can be a valuable leading indicator. Shares are also highly sensitive to corporate earnings news. If stocks prices rise faster than current and/or projected earnings, investors become concerned that the PE ratio is too high and that stocks are now overvalued. Conversely, lower PE ratios may indicate cheap prices for shares. Between 1972 and 1982, dramatic changes took place with the introduction of futures contracts on treasury bonds, currencies, and stock index futures. Since then, the world of futures trading has morphed with that of the more traditional stocks and bonds to such a point where they can now be barely separated. One result of this is the technical analysis methods used to analyse different financial markets have become more universally applied. It's become clear that the directions of movements of the futures markets can have an influence on those of stocks and commodities. Futures can supply early warning signs of interest rate and inflation trends, which will then affect FX and stock markets. As the stock market is divided into sectors and industry groups, profitable rotation into and out of certain areas is discernible from futures movements. The basic premise of intermarket analysis is that all markets are linked in some way. The direction of interest rate movements influences the stock market. Bond prices move in the opposite direction to interest rates or yield, and the interest rate can be tracked by the minute by observing government bond futures. When bond prices are rising, yields are falling, and this is normally considered positive for stocks. A comparison between the S&P 500 cash index and its related futures contract and the Treasury bond futures contract charts will show that they have generally moved in the same direction. In the short term, sudden changes in the S&P 500 futures contract are often influenced by sudden changes in the Treasury bond futures contract. In the longer term, Changes in the trend of the Treasury bond contract often warn of similar changes in the S&P 500 cash index. Thus, bond futures can be viewed as a leading indicator for the stock market. In turn, bond futures are influenced by the trends in the commodity markets. Note, in a disinflationary environment, bonds and stocks usually decouple. Bond prices rise while stock prices fall. Bonds are also linked to commodities. Treasury bond prices are affected by expectations for inflation. Commodity prices are considered to be a leading indicator of inflationary trends. Therefore, commodity prices usually move in the opposite direction to bond prices. Studying market history charts dating back to 1970s show that sudden upturns in commodity prices are usually correlated with corresponding declines in bond prices. The dollar influences commodities, commodities influence bonds, bonds influence stocks. The intermarket principles so far described are based on models dating back to the 1970s. The 70s were a period of runaway inflation, and this in turn favoured commodity stock prices. Since the Asian collapse in 1997 and the subsequent spread thereof, commodities have been hard hit. This has caused a bullish run in bonds and non-commodity stocks. Furthermore, the slower price rises observed during the late 2000s, beneficial disinflation, may now have turned into damaging deflation. This causes the bond and stock markets to decouple. While the inverse relationship between bonds and commodities is maintained, deflation can cause the stock and bond markets to develop an inverse relationship as well. Thus, while a relationship is always maintained, its nature may change in a disinflationary world. This brings us to the topic of fundamental economic releases. Nothing is more important in regularly moving markets than the publishing of economic statistics by governments and other central agencies. Every day, stocks, bonds and currencies bounce wildly in response to new economic indicators. Traders and money managers obsess over these statistics because they provide crucial clues about financial markets and the future of economies. It was once the case when traders would primarily concern themselves with US statistics, but with today's globalisation of markets through reduction of trade barriers, this is no longer the case. Below, or as we go forward, is an outline of the major economic figures that affect the markets. Attention to these figures is vital to your trading and will therefore form the backbone of the fundamental market knowledge leg of your training. Being such an important area, we strongly advise that you do as much personal research as possible on these topics. Most economic statistics are published at set times during the month, and it's important as a trader that you know what's coming out and when, what expectations are, and therefore what the proposed impact on the markets or trading will be. Expectations are at least as important as reality. This is often a decided fashion as to which statistics are regarded as the most significant at any point in time. Economic development should be judged in the context of trends and cycles. The trend, the long-term rate of economic expansion. The industrialised economies tend to have growth trends that last decades. The cycle reflects short-term fluctuations around the trend. We will now spend some time looking at some key subsections of economic data points, with the first one being GDP-related ones. GDP is the total of all economic activity in one country, regardless of who owns the productive assets. It's the main measure of national economic activity. Nominal GDP measures total economic activity in current prices and is significant because it describes total level of production or economic achievement. GDP per head measures output per person, GDP divided by population size, and is significant because it's used as an indicator of overall economic welfare. Output per head is a good guide to living standards. So if real GDP per head increases, it indicates an improvement in overall economic well-being. Real GDP measures total economic activity in constant prices and is significant because it's useful for tracking developments over time. Real GDP reveals changes in economic output after adjusting for inflation. Productivity GDP measures output for one unit of labour or capital. And this is significant because it indicates efficiency and potential total economic output. Productivity is highly cyclical since employment and capital are less flexible than supply and demand. Now let's look at some cyclical or leading indicators. These measure the economic cycle, and they're significant because it's a useful tool for short-term predictions of economic activity. There are 4 stages of cyclical activity. The first one is expansion, Demand first increases and gathers momentum automatically. Demand creates jobs and new employment creates more demand. Then we move to the second phase, which is the peak. Earlier momentum cannot continue indefinitely. Interest rates then need to rise. The third stage of the cycle is recession. Now, with demand falling, producers cut back on labour. Unemployment then works to reduce demand. And the final phase in a cycle is the trough. Output will fall to a minimum level, interest rates will then be cut and fall. There are also different types of economic indicators. So, we're going to look at some of these now, the different levels. So the first topic we're going to look at is leading indicators. So leading indicators include things like interest rates, business confidence, share price, housing starts, consumer credit, car sales, manufacturing orders, things like this. The next section is coincident indicators. So coincident indicators such as GDP establish a reference point for the overall cycle. Then we have what's known as lagging indicators. These include things like manufacturing capacity utilisation, job vacancies, average earnings, labour costs, productivity, unemployment, investment, order backlogs and stock. Leading indicators turn 6 to 12 months before GDP, coincident indicators turn with it, and then lagging indicators turn 6 to 12 months later. Now, let's look at some of these individual indicators or sections in their own merits. First of all, we've got employment. This measures total employment, employees and the self-employed. This is significant because it indicates total current output potential. It's highly cyclical, so when demand increases, employers tend to increase hours rather than new employment and vice versa. Watch hours and overtime for early signals. Unemployment measures people out of work but ready and able to work. This is significant because it indicates spare labour capacity, which is wasted resources. Highly cyclical. There may be a natural state of unemployment. Companies can hire up to a point of natural rate of employment. At that point, demand breeds inflation. Then we have personal income and disposable income. Now, this measures the personal sector total income and income after tax. Now, these are significant because it's the basis for consumption and savings. So personal consumption accounts for between 1/2 and 2/3 of GDP. Look for sustainable growth on real incomes. Too rapid and it becomes inflationary. Consumer and personal expenditure and private consumption measure spending by persons. And it's significant because it's a key component for GDP. Look for real percentage to change. If spending grows 6% and prices rise 4%, then spending has only risen 2% in real terms. Changing spending on durable goods can be an early signal. Next, we have consumer confidence. Now, consumer confidence measures consumers' perception of their economic well-being. And it's significant because it determines short-term spending, borrowing and savings plans from the consumer. A leading indicator, more confident consumers are more likely they are to spend money, which boosts consumer spending and economic output. Next, we have inventory. Now, this measures stocks held by producers and distributors. And it's significant because it indicates demand pressures, potential sales. Now, for this, you need to look at stock sales ratio. If ratios are higher than normal production, and imports will be cut unless demand increases. If the ratios are lower, the production imports should rise unless demand falls. Next is business conditions, indices and surveys. Now, these are anecdotal evidence of the business climate, and they're significant because they can be a valuable early warning of changes in the economic cycle, providing valuable evidence of perceptions and expectations relating to business conditions. Now, another one we're going to look at is industrial and manufacturing production. These measure the value-added output of mines and manufacturing companies. And this is significant because they're indicators of industrial activity. Industrial production as a whole is broadly indicative of the state of the economic cycle. The output of industries producing capital goods and consumer durables tends to be squeezed most during a downturn. Next up, we have capacity use and utilisation. Now, this measures the extent to which plant and machinery is in use. And it's significant because they're indicators of output and inflationary pressures. So strong economic growth with high capacity use suggests inflationary pressures. However, if demand is expected to remain high and interest rates are low, producers may invest in new plant and machinery. Next up we have, or related to this, is manufacturing orders. Now, manufacturing orders measures new orders received by manufacturing companies. And these are significant because it indicates output in the near term. Buoyant orders indicate upward pressure on employment and output in the short term. It may suggest a rise in inflation if unemployment is already low. Capacity use is high or inventories are low as well. Orders provide an early signal of changes in the economic cycle. A rise in orders may signal an end to a recession. A fall may indicate a cycle is peaking. Next, we have motor vehicles. This, of course, is measuring the activity involving cars and trucks. It's significant because it indicates manufacturing production as well as consumer demand. Vehicle sales are a reasonable leading indicator. Figures for cars are suggestive of consumption. Vans and trucks are indicative of investment. Next, we've got construction orders and output. Now, these measure activity, of course, in the construction sector. Now, they're significant because it indicates new investment and future output. Construction work is highly seasonal, so construction activity is sensitive to expectations of future demand and interest rates. Orders signal demand for building materials and labour over the coming months. Next up, we have housing starts, completion and sales, the whole cycle. Now, these measure the number of new houses begun and finished, sales of new and existing homes. It's significant because it indicates construction activity, industrial and consumer demand. Housing starts imply demand for materials and labour and are closely linked to population, earnings, employment and interest rate. Completions imply a sale, i.e. a new mortgage and demand for consumer durables. Sales are influenced by incomes rising and lower interest rates. Next, we have wholesale sales or turnover orders with stocks. These, of course, measure sales by wholesalers. And it's significant because it indicates demand. A fall in wholesale sales or inventories suggests or confirms slack in the business and retail demand. It's not as significant as retail sales, but it's worth watching. Now, retail sales or turnover orders and stocks. Of course, this is most commonly used by retailers. It's significant because it indicates demand. Retail sales cover up to half of total consumer spending. They're the key indicator of consumer confidence and demand. Focus on volume increases and decreases. Next, we have imports of goods and services. This measures, of course, purchases from abroad and is significant because it may displace domestic production and drain financial resources. A country imports goods and services because it can't produce them itself or because there is an advantage in buying abroad. Oil is often left out of the figure. Exports of goods and services. These measure sales in other countries and is significant because exports generate foreign currency and economic growth. Export growth boosts GDP, which in turn implies more imports. The greater the proportion of exports in relation to GDP, the bigger the boost to domestic output when overseas demand rises. Then we have trade balance, merchandise trade balance. These measure the net balance between exports and import goods. And it's significant because it shows the country's fundamental trading position. A large trade deficit may signal supply constraints. Companies are unable to meet the demand. The deficit may act as a safety valve and divert inflationary pressures. The balance of trade measures the relationship between national savings and investment. A deficit indicates that investment exceeds savings and that absorption of real resources exceeds output. Next, we have export and import prices. These measure the price of traded goods. That's significant because it identifies cost pressures, potential exchange rate problems, and changes in competitiveness. Compare export prices with domestic price indicators to get a feel for the way that manufacturers are passing on cost pressures to foreign buyers. Use import prices to judge external cost pressures. Next, we have producer and wholesale prices. These measure the price of goods at the factory gate. And it's significant because it's a leading indicator of cost pressures. Producer prices shed light on cost pressures affecting domestic production. During a recession, PPI may overstate cost pressures and conversely may understate prices during inflationary periods. Next, we have surveys of price expectations. These measure manufacturers' perceptions of inflationary pressures. are significant, of course, because they can be excellent anecdotal warning of potential price changes. You want to look for a change in the trend to suggest a potential increase or decrease in those cost pressures. Then we have wages, earnings and labour costs. These measure labour costs and the influences on consumer incomes. Of course, it's significant because it shows both cost and demand pressures. Wages and earnings are closely linked to the economic cycle. If earnings rise faster than consumer price inflation, real spending is growing. Then we have unit labour costs. These measure labour costs per unit of output. And again, it's significant because it can be an indicator of cost pressures and competitiveness. This is a key indicator of the efficiency of labour. If unit labour costs fall, the same output can be produced for less expenditure on labour. Then we have consumer or retail prices. Now these measure the price of a basket of goods and services. And it's significant because it indicates inflation as experienced by a typical household. Familiar and readily available inflation is an indicator, although timely, is not necessarily fully accurate. Then we have consumer or private expenditure deflators. These measure price changes affecting a consumer's expenditure. It's significant, of course, because it's a broad indicator of consumer price inflation, CPI, less susceptible to kind of fiddling than consumer price indices themselves. The deflator reflects actual spending rather than prices, in a basket approach. It can be useful to check on this for signals of other inflation indices. Then, of course, we've got GDP deflators. And this, of course, measures overall national price changes. It's significant because they're the broadest indicator of inflation. A deflator measures the difference between current and constant price GDP and its components. If GDP increases by 2% in real terms and 5% in nominal terms, the implied economy-wide rate of inflation is 3%. Deflators are valuable for identifying trends and obtaining advance warning of price changes. So as you can see, there are a lot of core concepts that you need to be aware of, and as I've already mentioned, it's vital that you take the time out to personally research these in more detail until you have a clear understanding of them all. This is because we'll be coming back to them later on, and you will constantly be seeing them referenced throughout your research and analysis in your whole trading career. So this concludes our introduction to financial markets, and we'll be focusing a lot more closely on the FX markets from now on and zooming in first of all on the basics and then the most critical things you need to be doing in order to remain profitable.